Never used to be the case that people really thought about the value. We used to say, you could have the Taj Mahal, but if no one's staying there, there isn't an underlying value.
Yeah.
Well, I think it's fair to say that accommodation anywhere's got value.
Yes.
Tell me, what did you think was the most interesting stat in the report?
It became more and more evident that profitability is ultimately what's going to drive this long term, this industry.
Don't let per keep scare you.
Yeah.
I think there's some great properties that 12 months ago didn't sell because of the per key rate. Welcome to Resort Brokers Radio. I'm Trudy. We're going to walk you through the ever-evolving landscapes of hotels, motels, caravan parks and management rights. Here we have experts from all across the accommodation industry, and we've invited them along to tell us all about their success stories, the lessons they've learnt, what their predictions are for the market going forward, and what trends they're seeing. Please join us. We look forward to seeing you there. Hi, and welcome back to RB Radio. Today I have got Josh, our fabulous property economist, who's worked with us at Resort Brokers for 5 years, and we've just come back from doing the first roadshow across the country for the first ever Motel Report. And hasn't it been amazing, Josh?
It has been great.
I mean, you and I have been dreaming about having all this data in one place, and just so interested to see what the numbers said and if it was as we thought it was, which in most instances, not every though, but to see it in reality, all 83 pages. Congratulations.
Thank you.
Amazing.
Yeah, it's certainly been a labour of love, but like you said, something we've been planning on doing for a long time. And I think doing the management rights report for almost 4 years now gave us some real confidence and a bit of a framework about how to approach it. So here we are, finished product.
Here we are, and it's obviously in all the national press, and we had hundreds of people in 7 locations. Where did we go? Port?
8 in the end. We started in Brisbane.
Brisbane, yeah.
Yep, then we went into Port, drove to Newcastle.
Yes.
Then we
let's go through what the trip
Stayed
was.
in Sydney that night, and then we flew to Melbourne the following morning.
Yes.
And we did we stayed in Sydney and then flew to Orange. Flew back, flew to Melbourne that night.
Yeah, so 3 flights in a day.
Yep. That was good. And then we did Melbourne that morning.
Breakfast, yep.
Yep, and then drove to Wodonga.
Yes.
Flew out of Albury the next day to Brisbane, got 1 night at home.
Yes.
And then we did a day trip up to Cairns and back. And then on the following Monday night, so the weekend after, did Sydney for the night and did the breakfast there the following morning.
I mean, unbelievable.
Yeah.
Really is, and I think it was my great idea that we needed to take it, to the people that the motel is, because I know, having worked in the industry for so long, how interesting this is, and there hasn't been anything.
Yep.
How did you go about getting it? Maybe talk through the process a little bit before we talk about what's in there.
I mean, obviously, we've got our own curated platform in terms of our own sales management software. So that was always going to be a great starting point.
Yeah.
But to be, I suppose, representative of the whole market, it probably wasn't going to be enough.
No. Only 1/3 last year. That's not enough of the market, is it?
Well, not to create a true statistical analysis, no. It's not a bad starting point.
It's not enough for anything.
But I suppose in the management rights report, we'd had great success with inviting valuers in particular but also other parties, groups like Arama, so an industry body, and we've even had interest from lawyers and the likes as well.
Fantastic.
To the point where last year we had 8 data partners on board for the management rights report.
Wow, how many did you first get? So
we started with 3 in the first year.
So 3 valuers the first time?
Yep. So exactly. So we started off this time around by approaching some of the valuation firms that we thought would be interested.
Yes.
Particularly the majors.
The majors in regards to motel.
In motel specialised assets.
Yep.
And people that we had good relationships with as well, and have sort of built that trust over time.
Yes.
And so we had Acumentus say yes.
Yeah, great.
We had Option say yes.
Yes.
And we had Jordan Hayes at Knight Frank say yes as well.
Fantastic.
So between the 3 of them, the report ends up looking at 11 years of sales between our sales and theirs.
Amazing, yes.
Just under 1,700 sales across the 11 years.
16,999.
Yeah, that's right. Sounds like a car ad, doesn't it?
It does sound like a car ad. And you're the least salesy person at Resort Brokers. Although the report sells itself. I mean, the news in there is so good because the underlying drivers of the industry are so good, right? Which I think anybody who's tried to book a hotel across the country, has gone away for a weekend. Anyone who runs a business knows how, obviously, it is more expensive accommodation. It does mean for our clients. They have enjoyed a couple of incredible years. But going forward, there's a lot of buoyancy because, perceived buoyancy because there's not going to be any new supply. Population growth moving. And that's probably why we've seen such a jump in the last few years. Like, I know the market's been hot, but I didn't realise quite how it had jumped 3 years ago.
Absolutely.
If I'm honest, I would have thought that it's revving up now, like it was hot with all these new real estate buyers. So not operators, drove around, saw great 10, 15 key properties across the country, thought, how much is this? $1 million, a couple of $1 million. And they, and so that really created a lot of repositioning of new buyers. But I wouldn't have thought that it was, so it's in that part, it's stronger than I thought.
I think supply and demand, which is something you touched on, is an interesting one too, because we can talk about it from an operational point of view. So in terms of how many rooms there are available and the number of people that want to stay in the spaces. And that's obviously something we touched on in the report. But on the flip side, there's that buyer-seller dynamic, which is where we're more involved.
Exactly.
And so there's that side of new entrants coming into the market with, again, limited rooms and total buildings in existence. And, the new entrants in particular, we've probably seen, a lot of explosion on that leasehold side.
Well, now you are. Straight out, though. When I'm talking straight out, to give it some context, I'm talking about 21.
Sure,
22.
yes,
Right, sorry, straight out of COVID. I hate using the word, but 21, 22. There was a real trend back to freehold because of these new buyers looking at real estate plays more. Never used to be the case that people really thought about the value. We used to say, you could have the Taj Mahal, but if no one's staying there, there isn't an underlying value. We wouldn't list it if we couldn't get figures that we could get through a bank and a valuer. Well, I think it's fair to say that accommodation anywhere's got value. And unfortunately, in a housing crisis and a building crisis and a huge population growth, 1,500 people a day or something.
It's
a perfect storm, isn't it?
It absolutely is, And you're right, you can see that sales upswing in freeholds. In the report, we looked at sales volume as one of the things that we disclose on an annual basis. And you're right, you can, at a national level, see that real upswing in going concern sales from FY21 onwards.
And the leasing code of conduct was still fresh in people's minds. So you had a thing where there was a great uplift to putting back together, effectively, decoupling, I suppose it is. Is it putting it back together?
Putting it back together, I don't know.
What's that term that Gwyneth used? I'll come back to it. That's what we should do. So what was your process with the valuers then? You reached out to them?
So we set up what we call a data partnership, which, again, is something that we sort of built out of the success of the management rights report. But effectively, as the leading share of sales, we're a great resource to valuers. And a lot of them often looking for ways to pay us back as well. And
it's a reciprocal relationship.
Absolutely.
It's good for everybody, right?
Like we help them in terms of providing sales evidence.
Of course, even when we're not on the deal.
And on the flip side, if they can provide us sales evidence to help price an asset correctly from day dot, then when it comes to valuation, it's so much smoother because nothing's been said unrealistically.
Not a waste of time or money. If something happens tomorrow, we can sell them out. I mean, that's very much a philosophy at Resort Brokers. But that's also why the report, right? When we I think, really prioritise getting this out this year because there's so much new capital looking for a home. And we think it's good for the entire industry for it to have a healthy industry. So we want everyone to be educated.
Absolutely.
We're never going to do all the deals.
But we do, and we are happy to talk to anyone about any deal they see.
Yep.
And we will always be honest with people, and they'll remember us when they sell.
That's it. Yeah. And it certainly is being received that way. And, you know, funnily enough, when we talk about attendees, valuers were the second strongest group of attendees to all our events.
Yes, right.
Yeah, so I got to meet, you know, well over 50 valuers personally across all of the events. which was fantastic. You know, given that we've started with 3 this year, I've already had emails just in the 2 days that we've been back from multiple groups expressing interest in joining up next year.
Fantastic.
Which is so great for this report and the quality of data that it will output.
And I know we won't yet talk about. I won't yet start promising what we want for next year when you're just about to do the management rights one. But even the fact there's 50 valuers who would be interested in accommodation. You know, we used to think of it as not that. You know, it's quite hard to get a valuer. It's quite niche, right? Like lawyers and accountants, because it's quite a sector. But I think not only is the value of it going up for all the reasons we've discussed, but the transaction volume for 50 people to be interested from a valuation is phenomenal to me.
Yeah, no, you're absolutely right.
You know,
for such what, you know, would have been traditionally considered very niche.
Wow, $15 billion isn't very niche, though,
not
isn't
anymore,
it?
is it?
How did you get to that? I tried to explain it for a week, Josh. Why don't you explain it?
So one of the metrics that we derived was a median per key price for property sold. And obviously you need to consider that based on how a property is run. So is it a freehold going concern? Is it a passive investment or a leasehold? And so effectively we came up with 3 per key rates across the country at a national level. And then took those and added up the number of keys in each of those regions, added it together, effectively like a rudimentary sort of a capitalisation, but on a median basis.
Yes, that's a lot of words, big words, Josh.
Rounded it out to 15 billion.
15 billion, amazing.
Yeah,
so much bigger. And, you know, the pricing's been another thing. So at the cold face, we know that demand, if you just look at what everyone knows about real estate, supply and demand.
Yeah.
And then if you look at the fact that no one's building a new one, even though there could be many across the country that would be full tomorrow.
Absolutely.
And they might even stack up on a piece of paper if you could get builders, if you could get lending, if you had the appetite, if you could cash flow it for 2 years or 3 years. So the prices, whilst they have seriously moved, they still represent good value compared to other asset classes, right?
It's true, yeah. Like even passive assets, which are probably the most like for like in terms of what you would see
Long-term
on a
lease,
day-to-day basis, where you've got a lease in place or weighted average group of leases in maybe a shopping centre or something like that. I mean...
Childcare.
We're still talking, you know, as a median for last financial year around that 8% mark for motels. Obviously, we're seeing that get a lot tighter.
We're seeing individual... I was surprised by that, you see.
Yes.
And that's because of the median thing, isn't it?
Yeah, correct. Yeah, so it's the middle piece. It's certainly not the tightest, and it's not the softest end of the market either. But even in that 2 months, you know, prior since the end of financial year, what we're seeing is
2.5 at 5.5%. I remember, obviously, with the leasing, and it was good to see the leasing, the rent as a general rule, and how it's
rent to turnover.
Rent to turnover. I still think rent to profits the safest because it's not about what you take, it's what you make, you know. But I think as a cross-check, and if you're in Victoria, that's how they do it. So, and if you do it both ways and you're within, then you know that the rent's sustainable, all things being equal. But I definitely can't believe the yields that are being achieved now. Like it used to be 14, and when I say used to be, I sold my first motel 23 years ago. Obviously, my father Ian, started Resort Brokers 40 years ago and set up the first lease. And up until 2021, 22, I would have said to you that the average was, to 2020, I would have said the average was 14 to 15%. Right? And
as a going concern.
As a freehold going concern, at 14.6, you could split it into a 30% for a lease, which is where they started, not where they finished. And then the more regional they went, you know, we'd sell things in places like the Territory for 40%, 42%. But at 30% was always the base, and then 9% for a passive, and 14.6. And then out of COVID, you had this perfect storm of properties just trading so well because everyone was on the road after being locked up. That reset rates, tariff, which is where the profit is, because your costs don't change per se. But boom, it went straight from that to, we were doing deals. We did a record deal straight out in Armidale of sub 9% for a freehold going concern.
Yep.
The norm now, you would say, is 9 to 11 or 12,
thereabouts, yeah.
right?
Yep.
And that depends very much on the scale. And yet when I looked at the median, it's 12.6, was it?
Low 12s, yeah.
Low 12s, early 12s,
yeah.
which again was surprising to me because that means you've got quite a lot that are over 13, 14, right? Because I know how many we've done under 10 or between 9 and 11.
Yep.
But I really believe that the days of double digits.
Quickly ending.
Oh, I think there's still more growth in it, even though prices are great.
Yep.
You know, it's an exciting time.
Yeah, absolutely. I mean, we've even done sub 8s, you know, in the last few months, haven't we? And passives in the mid 5s and tighter.
Interestingly, I was, without talking about the property, talking with one of our agents in New South Wales about a property that has been on the market. We'll come to that in a minute, though, because that was an interesting takeaway from it too. But it's 9.5% as a going concern, but that actually splits now into 6% for passive and into 25% for a lease, and that works.
Yep.
So they'd buy it for that. So it also means you can buy big going concerns if you don't want to operate them or it's not there. You can still get better than other industries returns, and we can sell a lease over the phone almost at the moment. 25%. Like if you look at that deal that Jacqueline did on the Central Coast that settled yesterday. You know, what was it? 24 rooms, 114 inquiries, 26 offers, 10 cash, 8 over asking price cash. I mean, who would have thought it? 22% for a lease.
And, you know, I was talking to someone in the room in Sydney and they said that they've even got a lease under contract in Toowoomba at 20. So you're just talking the most exceptionally tight results.
Well, but I know that our great brokers up there, and look, they're good, really great brokers. But and the leases, the thing about the leases is how long's the lease, who's responsible for what. There's a few technicalities
that feed into that.
It's probably the most technical move in commercial terms, particularly around tenure. But I know that Nathan Benjamin and David Frere's got 24%. Or 24, 25 in Toowoomba. I mean, that's again.
For a regional area.
You told me.
Yeah.
It was that. I know we did a big one in Brisbane in 2017, and that was 30 and 9. I remember when Russell Rogers did an 8% in 2019. I thought the sky had fallen in. It did. You know. So it's an exciting time for the space, and this couldn't be better received. So tell me then, in regards to if people are listening, what do you need from a data partner, like for it to be of value to the report? Because we want it to be the whole market. What is it, and what would they need to work with you, and what give you effectively?
Sure. Look, I won't get too much into nitty-gritty, but we're always happy to unpack it. But effectively, we're looking for as much sales information specifically about this asset class as we can. Obviously, we're happy to exchange information about things like caravan parks or management rights as well, and hotels, all the things that we
sell,
deal in.
Anything accommodation?
Correct. Yep. However, you know, we're just looking for key metrics on deals and the ability to reasonably identify that deal to avoid duplicating it. So sometimes that might be a room count, net profit, turnover, sale date, and maybe a postcode if we're not comfortable disclosing a name, something like that, just so that we've got enough information to be able to compare these things and make sure that we're not putting it in 4 times from 4 different valuers.
The wood, right? Because the same sales are used.
Correct. So there's just that element of deduplicating the data. A lot of our data partners have been kind and trustworthy enough to give us the names as well, which we're certainly appreciative of. But understand that that's not possible for everyone.
And we respect that. I mean, anything's better than nothing, isn't it?
Absolutely. And so just getting those key sort of deal metrics enables us to then include them in a statistical analysis.
Absolutely. And I know that we both feel very strongly. Well, what you did so incredibly was the time and how methodically you are and your department is in making sure it's got integrity, you know, and that's why it's really been successful in management rights. done at the same time when the management rights had a lot of new capital.
Yep.
So when I say sophisticated capital, I mean investment capital, people spending other people's money.
Yep.
Right, data becomes more and more important then, like it is now.
Yep.
But I know that report now is just absolutely, well, you're about to do the fourth.
Yep.
And the integrity of it and how much it's used and the confidence it gives the market.
Yeah. Yep.
And this will be the same, but also I know it's been great for the data partners because they've been able to go out to the whole network. They seem to be contributing to the industry, so there's been a lot of goodwill.
Yeah, yeah.
I reckon it'd be great if we could get some of the multi-owners who have been buying. There's so many cash deals. That's why we really want to invite owners.
People beyond just valuers.
Yes.
Yeah. Yep.
Just because I think there'll be.
I mean, I love valuers. Don't get me wrong.
No, we love you valuers. Of course we do.
Yep.
Yeah.
But yeah, absolutely different. Involvements in our industry, see different elements of the deals and see different deals entirely. So even things like, solicitors, they're going to be involved in every deal.
Everyone, everything we can, because I know you can extract data.
Yep.
You see people as walking data points. But I also was speaking yesterday to one of the big IT booking software providers, and they mentioned that they'd like to contribute. And how amazing would that be to also really have where the demand is, just to be able to pad out a lot of those things, the lawyers for things like lease turnover, length of stay, which is definitely, when I say length of stay, not guests, length of stay of an owner
tenure.
in a property, tenure. Yeah, exactly.
Yep.
Used to be 4 to 5. I'd punt now, I reckon it's closer to 7 on average, which is different to a median.
Yes, spot on.
Absolutely. Tell me, what did you think was the most interesting stat in the report?
I suppose, like presenting it, it became more and more evident that, profitability is ultimately what's going to drive this long-term, this industry. And so it was very interesting to see the median per key trends.
Amazing.
And, we expressed just even in the early production of it, how valuable that would be in terms of helping our clients see how the market moves over time.
Exactly.
But I suppose that, my takeaway from it was, as fascinating as that is, that's not what's actually driving the market. It's not a resetting of per keys that's driving it. It's I suppose, it's a knock-on effect of what is fundamentally underpinning that, and that's the profit increasing and yields tightening. Yeah.
And that's how it should be.
Yep.
To be honest, I'm so delighted for that from the point of view of, I think there's some great properties that 12 months ago didn't sell because of the per key rate. I got one just locally.
Yep.
That the per key rate would have been a record. We did a deal in Brisbane where we effectively put a lessee and landlord back together. The landlord didn't want to sell. There was $2 million more.
And that's in the report if anyone would like to read it.
And that was in here as a case study. But then that was, what was it? I want to say $338 per key. It ended up being that deal. That was a record for a motel in Queensland. Before that, we had done a similar deal down in Bendigo and then Wodonga. They were the records regionally per key, but it was a factor of the profit. It was the tightest yields also. They correlated, except Brisbane didn't correlate, right? But then this property was a fantastic business. But two things: the operating costs seemed low for the profit. Right, so the profit was over a couple of $1 million. So the idea that operating costs were sitting in 35%, 36%, which is tighter than the average of 40, was a question. That came down to length of stay and direct bookings and good APRs. But that was a great property. Couldn't sell it a year ago, and I think buyers missed out on something great because they weren't confident about the per key. It was $450. What can I tell you? Wait for the figures, gone. And I think it'll be more expensive. So I actually think you've got to feel comfortable. Don't let per key scare you.
And that was certainly the feedback I had from valuers too. Like, as much as they might include it as a metric, that's not fundamentally what's driving their valuations. So as an owner, if you're concerned, don't be, like a value might ask for some higher per key comparables just to understand how the market's moving. But again, it's yields fundamentally that they're looking at, not per key rates.
Do you know, some people have said to me, why would you put all this because obviously we've had such great data because we sell 200 of them a year and have done for 40 years, right? So we've got quite a good share, a third of it, out there because it'll help other people get their deals settled. But I just think it's fantastic for the whole industry to give it confidence, for everyone to be successful. Thought it was funny though. Why would you do that? Hey, so Josh, just lastly, in regards to how you set the report out and what your thinking was behind that?
Yeah, sure. I guess there's just so many aspects of the industry that we could consider. So, like I touched on the fact that we could look at ADR and occupancy, for example, and how that supply and demand equation is different to the buying and selling supply and demand equation. So there was that side of it. And then there was the fact that we wanted to actually give an image of what this industry is, and that no one had done that before. And so that kind of made it fairly clear in my mind that we needed three...
Glad it was clear in your mind, Josh.
Three key areas for this report. So our industry analysis, which sits at the front, so that tells us about our 3,500 plus motels across the country, that they're worth $15 billion, that a third of them are, run split, so as leaseholds with landlords, and 2/3 of them are going concerns, and how the rooms are broken down in the locations. And then we've got that ADR and occupancy side, which we've called the performance analysis. And then we've got our sales analysis, which is where all of that value from our data partners comes in, helping us paint that picture over time of yield performance, per key performance, movement in
cost,
leases, costs,
all scale
of it.
In locations.
And then, obviously it's 83 pages. We started slicing and dicing it by its geography as well. So as well as looking at the whole country, looking at by state, but then also, we often talk about the variance in yields from capital cities, coastal markets and regional markets. So that was like another obvious one. So we had to kind of sit down and think through, well, how do we define these things? Which is something that we did get asked a couple of times about in the Q&As, but effectively using postcodes and looking at anything that touched the shoreline of Australia and treating that as a coastal market, unless they were excessively large postcodes, and we'd trim them back. But that was sort of a good approximate way of creating some clear-cut regions as well. And
so coast, regional, capital.
Yep. And so inside that, we could have broken it down again and gone to, Queensland coastal, for example. But you start getting too small and you lose a little bit of integrity in the data if there's not enough scale.
Even the capitals where nothing transacts and there's so few of them.
Correct. So we only did the capitals at a going concern level rather than passives and leases, just because there are so few. But it's certainly, again, as we get more data partners on board and that quality improves, it just unlocks potential for this to double in thickness,
it does. You'll never sleep
and we'll
again.
just have to be very, particular about what are the most salient points. And obviously we've provided a 10, 11-year analysis now. And
this is sizable. Did you find the first management rights one was the most sizable?
Quite the opposite. It was the smallest because it was sort of the first point. And so as you gain more data, you gain more insight.
People understand how you deal with it too. They understand how well received it is. They want to be part of it. They know it's good for it. Obviously, the way you think and look after things, amazing.
Yeah, and it's incredible that they've gotten thicker in the management rights space because even though there's been more data, we've actually cut down the length of time we've considered. So the first one was a 5-year analysis, and then we went to 2-year analysis, and they're not as thick as this even, but you can imagine that with more data partners, even if we trim the view that we're looking at, it's going to end up.
I know we could do a whole one on leases, all kinds of things, so on, which I think
we've had a lot of ideation on the road.
We have had a lot of time to go through McDonald's drive-thrus and walk through airports and rental cars and talk about where it needs to be. But I think my biggest takeaway from it was the per key and the activity and the yields. I could see it was the fact that the old coast was show inland for dough, which is what I thought you were going to say. And that's what I was saying. Say it, Josh. Is almost irrelevant now. 1%.
The leases were
leases. I mean, that's phenomenal. I mean, obviously, it's regional Queensland still represents the best value as far as it's still got opportunity compared to the other southern states.
In terms of the easterns, we didn't necessarily even unpack states like South Australia, which can still represent exceptional value if you can find the opportunity. Can I tell you,
absolutely, Northern Territory again. WA, I actually think is, and Blair's results he's getting over there, I think represents great value.
And scale too, you know, again, being more regional heavy, particularly WA, you can get some big assets over there.
You can get a good portfolio, and I know that there's capitals going there, a bit like they were to the Territory 5 years ago. Sure. But now we're going down a rabbit hole. Hey, Josh, we are so proud to have presented the report. You've done such an amazing job. It's only the beginning. We are the whole industry wants to thank you. We are so lucky to have you as part of the team. Anyone wants a copy of the Motel Report, they can download one from our website, Resort Brokers, anytime. But I think we're going to get the valuers in too, our data partners, and talk about it even more, because I think the feedback from the moteliers, the people out there that we've seen in the last 2 weeks, just shows me how much appetite there is for knowledge and information. So we should invite them on. But thank you, Josh.
Great idea.
Really, thank you for everything.
Appreciate it. Thanks.
Thanks a lot.
Thank you so much for joining us at Resort Brokers Radio. Please subscribe and follow us, and give us a 5-star review so we can be back again next time. Thanks a lot.